Happy Monday, guys. Welcome back. Hope you had a great weekend. I love Mondays because today we have a special video talking about the 5 facts you didn't know about passive income investing as it relates to dividends. Now, when it comes to passive income, I have made it my personal life goal to make my passive income cover all of my big expenses like my house, my food, and my car, of which, as a starving YouTuber, I have none of those things. And you know what the critics are saying? It's all because millennials are broke. And all of that is 100% true. Yeah, it's true. It's all true. Now, I have been extremely fortunate to have been investing since I was about 19 years old and building my dividend income portfolio right here with Robinhood. Right now, it's worth about $186,000 and it's paying me about $550 every single month. Now, this is about to become relevant information in just a second, but this does not count my WeBull portfolio, which is approaching almost $10,000. It'll be there soon. So thank you guys so much for all the support, and I will be making a WeBull update video very soon. And the last thing I'm not mentioning is, of course, my other holdings, which I don't want the IRS to know about. Starts with B and ends with Itcoin. So now we're about to begin. I'm going to show you the 5 things and the 5 facts you didn't know about. It's about to get technical and data heavy, so bear with me. I promise it's going to be good. So smash the like button and let's begin. At number 1, believe it or not, dividends have accounted for a huge percent of growth in the entire stock market. Check this out. I'm about to blow your mind. In a study called Why Dividends Matter by fund co-managers Dr. Ian Mortimer and Matthew Page, when looking at the long run at the S&P 500 historical return since 1940, we can conclude that reinvested dividends have accounted for over 90% of the index's growth during that time. Just think about that for a second. Reinvested dividends have accounted for over 90% of growth in the stock market since 1940. Let's assume you were able to invest $100 at the end of 1940. This $100 would be worth $174,000 at the end of 2011, assuming you had reinvested those dividends, versus only $12,000 had you not reinvested those dividends. What a crazy big difference that makes. This $100 would be worth exactly, almost perfectly, what my dividend portfolio is at this moment. This is exactly why, personally, I reinvest every single dollar that I get from my dividend portfolio back into itself, which right now is about $550 a month. So I like to think of every dollar like my little soldier that goes out and fights all my battles and recruits other little dollar soldiers, and he is relentless, nonstop, doesn't ask for paid vacations or sick leave. And if you don't like that analogy, we can use something less government and military, like, I don't know, Jehovah's Witnesses. They are also relentless, and they will knock on your door and they will try to recruit every single one of you, unless you combine them with an atheist, in which case you just get a guy who knocks on your door for no reason at all. Now, you might be saying,
well, that's not fair, Andrei. You're an idiot because you're using time periods that are favorable to prove your point.
And that is a very fair critique. I also don't like it when people do that and they use data and mathematical models to support their conclusion because they use data that is favorable to proving their point. So let's be as objective as possible and use unfavorable data to try to illustrate this same exact point. If we look at low growth periods, such as the 1940s and the 1970s, well then, still, reinvested dividends have accounted for over 75% of the stock market returns. And why is that? Well, that's important because reason number 2 you may not have known about is because dividend companies fall less hard during recessions and they recover a lot quicker. So here are some recessions to illustrate this exact same point. So check this out. Example number 1, November 1973 to February 1975, dividends per share, DPS, fell 1% in comparison to earnings per share, or the EPS, that fell 15%. The next recession, from July to October of 1981 to 1982, there was no decline in dividends per share, while earnings per share fell 9%. The next example, example number 3, 1990 to 1991, dividends per share fell just 1% and earnings per share fell 32%. Example number 4, June 2001 to December 2001. DPS fell 6% and EPS fell 54%. And the last example, which is the most recent recession, the housing bubble of 07 and 08, DPS fell 24% in comparison to EPS falling 92%. So why is that, Andrei? Why are dividend-paying companies so special, and what makes them so protected during economic recessions? I don't get it. Well, it's true that some companies can and absolutely do freeze or cut their dividend entirely during hard times. Rarely, if ever, do they cut their dividend dramatically all at once. And that's because a dividend represents a company's future earning power, and it's supposed to be set at reasonable payout levels that are supposed to be sustainable no matter what the market conditions are. Another factor that helps this cause is one that many dividend investors, including myself, share. And it's this unique personality trait that is somewhat counterintuitive, and it's that we all love Dragon Ball Z. Now, Goku! I'm sorry, that King Kai impersonation was just itching to happen since the start of this video. It has nothing to do with it. The reason is because all dividend investors love to use those dividend paychecks to buy more high-quality dividend-paying companies for less. In other words, stocks that are depreciating in value, because by doing that, we're going to multiply our income much faster. This is very much in contrast to how growth investors will invest their money. Like, let's say they invest into Tesla. Now, this is not necessarily true for every Tesla investor, but for many of them, they chase short to midterm profits, and they will wait for favorable conditions when this company reports favorable quarterly income reports and says that it's made money. And if it doesn't, the share price will drop in value, and many of those investors will get skittish, they'll get scared, and they will pull out. And by doing that, they're just going to lose money. So you can see how dividend investors have a lot more staying power, because we're much more motivated by this constant flow of cash and income that we receive on a monthly or quarterly basis. So if you think about it, it makes perfect sense why dividend investors and dividend companies have done much better during economic recessions. And this dividend investor confidence also comes from reason number 3, and that is profits are a matter of opinion and dividends are a matter of fact. Now, some companies have been known to make it seem like they're a lot more profitable than they actually are. And there's a lot of different creative ways that a company can do this, but that's a video for another time. Now, share prices in the stock market are not always super accurate and reflective of the truth. And that means if a company is not paying dividends and it's just a growth company, that makes it a little bit more difficult to assess just how profitable that company really is. We have to trust the CEO and the company about reporting its own profitability and hope that they are not lying to us, the public. And of course, that has happened before. However, if a dividend company is not profitable, then it cannot pay its dividends. It's just that simple. And as a dividend investor, I know that each and every dividend that I receive is 100% real. It's coming from real profitability, and it's a real dollar. It cannot be manipulated by creative accounting to make it seem like a company is profitable if it actually isn't. And this one simple fact gives me all the confidence I need to continue investing more money. The fourth thing to be aware of, which should also help your confidence that you may not have heard about before, is that a dividend-paying company will pay you the same amount at the basis at which you bought it at, which means if you put in $100 into a company that's paying you 4%, it's going to pay you that $4 regardless of what the share price is worth, whether it's half or double, assuming the company doesn't freeze or cut its dividend altogether. And that to me alone helps me sleep at night. And no, just because a company is going to pay you 4% or $4 a year does not mean it's going to take you 25 years to make back your investment. That's not how it works. That's inaccurate. Well, that's stupid. You're going to take 25 years to get back that investment. That's not at all how it works, because the principal value of your shares, assuming that it's a healthy growing company, will also appreciate, as should your dividend, which is a pretty incredible thing. Now, at what rate does it grow? Well, that is reason number 5. Dividends are an inflation hedge. When looking at the S&P 500 dividend growth rate over a 10-year rolling period since the 1940s, oh my God, that was a mouthful, we get a 6% dividend growth rate, which is ironic because my portfolio has done 6.2, which is nearly identical in the last 10 years. And that is amazing because when looking at inflation over the same period of time, that is 4%. So your dividend growth rate is growing faster than inflation, protecting your dollar from losing purchasing power and dim sum. Some other things to mention about dividend stocks that people misunderstand is that when a company pays said dividend, the share price will drop by the same amount that it pays its dividend. So you can't, for example, buy the stock before the X date, get the dividend, and then sell the stock the same day thinking you've outsmarted everyone. So Andrei, what's the point of investing in dividend companies if the share price will just fall by the same amount? Doesn't it just cancel out? I'm saying it like a brat because some people comment like they're so clever, but in theory, yes, that is how it works. But in reality, that is not always the case. Sometimes the share price will drop by less than the dividend, sometimes more than the dividend, and sometimes the share price will go up despite the company paying its dividend. That all depends on a few factors, including how shareholders perceive their value to have been affected and impacted. But that is a story for another time, kids. And that is how I met your mother. I don't know. Dividends are also one of the few tax-advantaged investments that you can receive. Maybe besides the Roth IRA, which is less of an investment and more of an account that holds all of your investments that will pay you out when you're ready to retire tax-free. And also, I might set myself up with a Roth IRA and make a tutorial despite making a video explaining why I didn't have one. So comment down below and let me know your favorite way to passively invest for that sweet income. And of course, since it's taboo to talk about money, I want to know how much money you make passively. And since this is the internet, I'm ready for billions and billions and billions and billions. Hit me with your best. Love you guys. Don't forget to smash the like button and subscribe, and I will see you lovely people on Friday. Blah.